and Valentina Sanchez Cuenca from the Bird Traps Report with the Latin American team. Since 2010, Larry and our team host a live institutional client chat on Bloomberg, which we have more than 660 buy-side investors that participate in this platform. We have traders, portfolio managers all around the world. We have a recap that we send to all of our clients daily, and globally, we work with over 60 outstanding contributors in the Bloomberg Live chat. Please welcome Larry McDonald, founder of the Bird Traps Report, CNBC longtime contributor, and New York Times bestselling author with his book A Colossal Failure of Common Sense. Also, welcome Robert Van Battenberg, CFA with more than 25 years of experience, longtime friend and contributor to the Bird Traps Report, and his opinions are always valuable and well received with the team. Also, remember to pre-order our upcoming book, How to Listen When Markets Speak. You can find the link in the description below. And welcome to our segment.
And we talked about this already last week, is that one after another, these traditionally defensive sectors have been taken to the cleaners, right? So you started with telecom, traditional telecom, got decimated for a variety of reasons, lead cable scandal, increased promotions, increased competition. And then you had the REITs, right? The REITs were always seen as a form of, buying fixed income, but then in the form of equities. They paid high interest yields, but they've been destroyed. Then, of course, secular headwinds like office, vacancy rates and retail REITs, the emptying of stores in Main Street. So, one after another, these defensive sectors have been destroyed. And then, of course, you have a massive decline in bonds, which has been driving down utilities, and also staples were essentially the Johnny-come-lately in this massive puke. Also, part secular. Also, just because people were getting jittery about what happened with the consumer, what happened with the interest rate, and what have you not. So then you have the FANGs, right? And then you have the mega cap tech. You have companies like Google, you have companies like Microsoft, you have companies like Facebook, and generating an enormous amount of cash flow every single quarter. I think Google's cash flow on an annual basis is $80 billion, right? Apple, they have $150 billion of cash on the balance sheet. They're not growing much anymore, but you know where they're going. And so these stocks have gradually adopted the multiples that were once given to Coca-Cola, McDonald's, trading at 15 to 20 times earnings relative to their cash flow. And so you've seen that as that market was running away from these traditional defensive sectors like staples and telecom, it went deeper and deeper and deeper into these mega cap tech stocks. So today we're seeing the opposite. We're seeing that they're underperforming because the Fed said basically they're done hiking rates. The Daily said it last Friday. We've had today also Bostic coming out. They're done, right? Probabilities of a rate hike have collapsed to almost 15% for November. I think the invasion into Israel was essentially the final nail in the coffin. We had already last week the turmoil in the House.
Where's the trade?
What?
Where's the trade? So let me just talk about capitulation here, because we don't, we want to go back and forth. We don't want to monologue, but it's very important that. So we have a 7-factor capitulation model at the Bear Trap Support. We have clients in 23 countries, institutional, retail. One of the things that we look for is like, where's the trade? Okay, so we're talking about a Category 4 hurricane capitulation in the staples. This is something you see in the staples once or twice a decade. This is equivalent to a COVID drawdown. That's 37% drawdown there in Conagra. And as you can see, the bottom part of that screen, I'm sorry that it was just moved, but the bottom part of the screen, the capitulation volume was spectacular. And that capitulation volume sets up, I think, we think, for a really attractive trade in some of these staples in the fourth quarter. So you can see there, 37% drawdown, RSI oversold, really, really high, intense acceleration and capitulation volume. So we're looking at right now as a category 4 capitulation score in the staples. Jose, next slide, and we'll bring it back to Rob. Okay, so Rob, you were talking about here the divergence between the Qs, the utilities, and the staples.
Right. Yeah, we've seen since the end of uh, July, we've seen consumer staples down 10%, utilities down 12, REITs down 9%. The Q's basically flat for all intents and purposes, primarily driven by these heavyweight tech stocks that were deemed to be more and more and more defensive in nature. And today we've seen the opposite. We've seen people running back into consumer discretionary, staples as well, semiconductors and Russell 2000 stocks. So we saw this morning also Pepsi numbers, right? They're all terrified that staples were going to be hit by a trifecta of headwinds. In part, the weight loss drugs, the GLP-1 drugs, were going to affect demand for junk food and fast food. Then you had higher interest rates that would lead the consumer to spend less, and also, the headwinds from years and years of inflation, and these guys just joining the party, raising prices willy nilly, and now they're paying the piper, right? Because nobody wants to buy
Yeah. So,
can't
so
afford
Rob,
the stuff.
yeah.
But
So
today,
that's
the earnings for
important.
Pepsi were
Yeah.
actually very good, and they raised the guidance for next year. So people are now realizing, well, all these, and this is what you're seeing oftentimes, right? When some theme basically catches on, everybody's jumping on
Yeah,
the
Rob,
bed.
can I come step in?
Wow.
But one of the points we made in the turning points, we have a turning point product that goes out every week, and we want to talk about the turning point a little bit. But one of the points we talked about was the reason why Pepsi had the worst 3 months since the great financial crisis. So just because the stock is bouncing today doesn't mean there's something really big going on, right? It did have the worst 3 months in a row since the financial crisis. You made that point this morning in the
Yeah.
chat. We run a live chat with institutions. So there's nothing surprising about a bounce out of the worst 3 months. And the big picture is if we look at the Conagra CFO and you look at other comments, it's pretty clear that the consumer we're hitting the bone. In other words, if your car payment's gone from $200 a month to $700 a month, and you want to go buy Slim Jims or some potato chips, whatever it is, or if you want to go to buy some Pepsi, whatever it is, there's just less money there for the company in the staples area to pass along the prices. And this is important because in every inflation cycle, the first stage there's aggressive price markups from companies like consumer staples, Hershey's, McDonald's. They can pass along those prices in the early stage because they have the excuse, oh, inflation, right? But oh, by the way, at some point you hit the bone, and we think, and I think Rob, you agree, over the last couple of weeks, because of that spectacular capitulation in the staples, it speaks to hitting the bone. It speaks to CFOs admitting that they really, even though the last 4 quarters they've been passing along prices aggressively, that game's about to be over.
Right. Right. And, staples have obviously started to price that in, as have, as a myriad of other defensive sectors. So that's where we are today. And yeah, I think, well, what else do you want me to say about this?
Well, I just think that, okay, you got the one big thing, and I'll ask you the question, Valentina, it's important for you. So in markets, if there is no crash, right? If there's no crash in the market, we often see rotations. And so if the safety zones over the last year were utilities, and as economists talk up recession, you had a 2-10 yield curve, you've got all these recession indicators that have been very high, leading economic indicators. So Rob, when you have this crowding into utilities and staples for the whole year, And then all of a sudden, in a 2-week period, that capital migrates out. And because there's no market crash, it has to go somewhere, right? So in essence, isn't it just literally, a super crowding into the queues versus before we were into the queues, the staples, telecom, and utilities.
Yeah, but I mean, we already kind of touched on that, but I'm happy to elaborate on it, right? I mean, the crowding into the queues is enormous, right? There's no question about it. Uh,
But I
there,
think
there,
what's interesting is the fact that when you have like classic sectors, there's safety sectors, when they break down in a very 10-day period, it creates an unusual shift that is like you went back, you did the data over the weekend, and if you can go back 20 years and you just don't see the staples and the utilities making a move like that. They're very rare, very together, because that's a lot of safety capital has to either go to cash or has to go somewhere else. And this chart shows it went to the Nasdaq. Valentina, any takeaways from you?
We offer weekly macroeconomic recap and overview. If you guys want to trial, you can reach me out at valentina@thevertropsreport.com. That's valentina@thevertropsreport.com. And I can offer you a free trial for 21 days.
Yes, exactly. So our clients are financial advisors, family offices, hedge funds, mutual funds, pension funds, and some high net worth individuals. But we run the live chat behind us. Rob's running in New York with the team. And what we're doing here is we want to give you that lens on what are the institutional investors talking about in the chat today. And that's what we're trying to do, with this segment. But, thanks very much. Rob, any closing points?
no, well, I mean, look, we have this afternoon we have a Fed Speaker Waller, right? And people need to watch this very closely because if he essentially puts the light on green, that means that the entire collective of the Federal Open Market Committee essentially agrees that the Fed is done with rate hikes and that they're going into a period of autopilot, right? And they're going to see where this all is going to end up. And that speaks to what you, Larry, was saying, that the pressure on the consumer, the pressure on emerging markets, the pressure on the yen, the pressure on both domestic as well as international markets has become so much that the Fed needs to stop. And we've heard that from a number of Fed speakers that are labeled as dovish. Now we're going to hear from Waller this afternoon, and he's basically just going to stick a fork in the Fed's rate hike cycle policy. And historically, when the Fed is ending a rate hike cycle, that means that gold becomes much more attractive, right? And it could also help risk assets, at least for temporarily, until the market starts to smell that this is more than just a blip and that the recession is upon us. So I think we need to watch the dollar. We need to watch gold here. And for the rest of the week, the market is obviously focused on PPI tomorrow morning, producer prices, and CPI on Thursday morning. Whether the Fed can basically step back and stop monetary tightening. And then on Friday we have bank earnings, and of course it's very important, as you pointed out early in the speech, that balance sheets are extremely vulnerable right now. So we want to see if those earnings are what are the charge-offs, what are the non-performing loans, what do these balance sheets look like?
Yeah, I think when you have Mary Daly Friday, Lori Logan yesterday, all kind of signaling, Logan's pretty hawkish. So if you have three Fed governors, they're essentially what's happening is, I'll close it with this: the beast inside the market, the stress on Citibank in emerging markets, the stress on Bank of America and the mortgage and your core capital and treasuries in flames. There's just a lot going on. Emerging market credit default swaps ripping wider. And if the Fed doesn't contain the dollar and doesn't contain front end rates right now, they will cause a Lehman type event in Bank of America and Citi. I'm very confident of it. And that's why the beast in the market is about to break the Fed over its knee. You want to have put on bets right now that are negative on the dollar, long hard assets value. We're looking at industrials versus tech. Stay with us next week in our next segment, and we appreciate you being here. Thanks.